Good morning, good afternoon, everybody. This is, I guess, good evening. It's 8 o'clock here. Sorry to do this so late, but my wife is at some event, and my kid goes to bed at 7:30 Central. So if I wanted to do this without a small child going, Dad, 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 I'd start at 8 o'clock. So let me lead off by saying that today is for education only, and if you have questions or you're not sure about this, consult your financial professional. We are an education service. If you see something and you lose money, it is your own dumb fault. Love Option Pit. So let's talk about Option Pit. If you don't know too much about us, I think you guys all do. This is me. I am Mark Sebastian. I am the founder of OptionPit.com. I was a floor trader for, call it a decade, and then left the floor and started Option Pit. That's funny. So somebody said, which one are you? Very funny. I'm the hot redhead. So with a deep voice. So the Option Pit kind of works with all levels of retail trader. We'll work with new retail traders all the way up to professional. We also have a consulting operation that works with money managers, asset managers, wealth advisors, implementing option strategies and option overlays. I like to say that we've got clients with $1,500 and clients with $15 billion. And we really do enjoy what we do. We get to kind of see the entire kind of scape of the world. And the other piece I would say is that on top of that, we don't consider ourselves really an education company. I manage a hedge fund, and Andrew, who's my number 2, is the head of risk for the hedge fund. So we consider ourselves traders who teach, not educators. So that would be the one thing I would really say about us right now. I think that maybe differentiates us. All right. So let's talk. So what we're going to talk about today is volatility. Volatility can act like a headwind or a tailwind to successful trading. And it's really, I fly from Chicago to New York a lot, and my flight to New York is always 45 minutes faster than my flight back to New York, or back to Chicago, and that has to do with tailwind. All right, and volatility, if you use it right, can be a tailwind. And so what we're going to discuss is basic buying and selling decisions. We're going to talk about how strike selection can make the difference between a good trade and a bad trade. We'll talk about some combinations that I use a lot, and I'll show you a couple of trades. And then I'll give you a tip for day traders and swing traders involving VIX and VXX, and maybe some thoughts on what the action looked like today. So now the key to trading options for direction is to understand this concept of correlation. Correlation is how one instrument moves with another. All right, so for instance, if I tell my wife she looks fat in a dress, there is a 100% correlation with me getting hit in the head. Reasons why I would never say that. And on top of that, my wife is really hot and doesn't look fat in dresses. So, but, that's just the way it is, all right? If my kid kicks me in the shin, I can 100% correlate that I will get angry, all right? So a correlation of 1 means the two will move together perfectly. Options can never have a correlation greater than 1 or less than -1 relative to their underlying. So if you buy a 1 option contract in IBM It can never correlate more than 1, and it can never correlate less than -1. So delta, all right, we use the word delta kind of interchangeably with correlation, and that is really kind of the best way that we look at it. It can be called slope. You know, my sister teaches chemistry and physics and biology, and has a dual degree in bio and chemistry, and she's like, I don't understand any of your option stuff. And I said, well, you know, all this delta. She's like, I don't know what delta is. And I was like, all delta is slope. Slope of the option to the underlying. And she's like, oh, well, I get that. That's easy. And so most engineers and scientists get kind of the math portion of this piece. and you know, that's just the way it is. So delta can change, all right, and I'm going to talk about how it can change, all right, and there's some important factors. So again, we describe it as the correlation. So an option with a positive 0.6 delta will make 60 cents for every dollar the underlying rallies. So IBM's trading 135. The 135 call has a 0.5 delta. So if IBM rallies $1, my option will make 50 cents. All right, and it will lose 50 cents the other way. All right, so if it was worth $2 and IBM drops $1, it'll be worth $1.50, my option. So just kind of understanding the basics. All right, now what makes delta so hard is that relative to a stock, it can change on a trader. All right, there's some drivers that in change in delta that are easy to understand, like price movement and the passage of time. You know, if I buy a, you know, there's this concept I call the cone of feasibility with time. So Apple, let's just say Apple. Who thinks Apple could be trading 150 by next week? Highly unlikely. Who thinks it could be trading 150 in 3 months? It could happen, but it's still highly, highly unlikely. All right. And then in a year, all right, well, that's possible. And if you think about how your mind moves from that can't happen to that probably can't happen to that's entirely possible, that's really how delta moves with time. A year from now, that 150 call is going to correlate a lot better to the underlying than that 150 call that expires next week. And that's kind of the cone of feasibility and with time. Now, price movement, super easy, right? An underlying rallies, you know, an Apple call has a 30 delta. The underlying moves up $1. The call makes 30 cents. Super easy. All right? Super easy. So the one thing that can have the greatest effect on the performance of a directional trade is change in volatility. All right? There's nothing that can really affect your trade. Nothing that will really end up deciding whether you make money or not than having an understanding of volatility. You know, pricing, you know, the price movement of a stock is pretty much a crapshoot. The volatility movement is not. We're going to talk about that. All right? We're going to talk about that in some detail. So let's kind of talk about this. So this is kind of how a stock will, this is my best drawing. I had to draw this myself. So this is kind of my best drawing of how delta can move with the underlying increasing in price. The blue line kind of represents kind of delta movement and how the option moves with the underlying in terms of its price movement. And so the question is delta probability. You know, people look at it that way. It's not the exact probability, but it's a good it's a good shorthand calculation for probability, but it's not the exact formula. Does that make sense? It's within, you know, it's good enough for government work, but it's not it's nothing exact. It's nothing that a market maker could use, but it's certainly for your average retail trader, it's pretty decent. So, has this ever happened to you? All right. Market makers are, I used to get this all the time. I remember I specifically had a client say, you know, you guys are cheaters. I buy these calls, and then the earnings, right before earnings, and then earnings comes out, and the calls aren't making money. You guys stole money from me. And the answer is no. That's not what happened. Volatility changed. All right. So let me talk to you about the differing forms of volatility and really what the pricing model represents. All right. So when we come up with the Greeks, we're going to talk about this in a second. All right. The Greeks are an output, they're not an input. All right. So anybody who's used to modeling should have an understanding of the difference between an output and an input. An output is the results of what assumptions you make up. All right, or what assumptions are put into your model. So if you're modeling your risk, then the Greeks are only as good as what you put into your model. All right, so the Greeks, including delta, are really meant to help you manage risk, but they're not perfect. The Greeks are not a hard number. They can change on you. So let me just kind of walk through the pricing model real quickly. All right, well, right here. So you've got your option price, and your option price is derived from the 5 factors. All right. There are 5 pieces of every pricing model. There are other things that get added in, but there are 5 pieces to every pricing model. All right. You've got the price of the underlying. You've got the strike price. You've got the timed expiration. You've got the cost of carry. And then you have forward volatility. All right. Now, what is forward volatility? Does anybody here know what forward volatility means? No, yeah, it's not historical. That's for sure. It's not the same as implied. It is not the same as implied. So it is the expected movement in the future. It is the future. All right. The only time that we've seen that work is in Back to the Future when the guy gets when he gets the sports betting almanac from 2015 and goes back to 1985. Yeah, and he does get, yeah, he got the Cubs right. Thanks a lot, Scott. Rub it in some more. So the real key is that the real key is forward volatility is an unknown. We don't know forward volatility. All right, but what we do know, so we've got this that we don't know, right? Let me erase that. My best drawing. So we've got this we've got forward volatility we don't know. All right, and we've got the option price that we do know. All right, so what do? We actually flip-flop these. We move forward volatility to this side, and then we move the option price here and solve for what's implied volatility. All right, so what's going on is the option price itself is really pushing out the Greeks that you get, including delta. All right, so after we solve for implied volatility, think about this. After we solve for implied volatility, so we solve for IV, we then pump that back over here, and then this stuff outputs the Greeks. So yeah, implied volatility is our best guess, and it's what pumps out the Greeks, including that delta. You ever heard of the term garbage in, garbage out? If the option price is really wrong, that means the implied volatility is wrong. So, so if the implied volatility is wrong, that means that the price of the option was wrong, which means that the Greeks are going to be wrong, which means your delta changed on you. And that is why you lose money if you don't understand volatility. All right. So that is how delta can change. So the option price changes, and then the implied volatility changes, and then the delta changes. So let's just take a look. Best Buy had earnings this morning, right? This red line represents implied volatility. Crazy. So let's take a look here. And this is where people get beat all the time. So I think Best Buy is going down. All right. So I'm going to buy the November 31 put for $1.50. All right. Well, let's see. So the implied volatility in November is 178, and I'm buying a 45 delta. Well, you can see the underlying was down 66 cents. So let's see what happens on the day. Here we are. Well, my delta is 67. My options are 50 cents. Look at that IV, though. It's down 130%. You want to see something more drastic? Look at the 30 puts. So the 30 puts are pricing a $1.10 with a 36 delta. The next day, with the stock down, the options are 10 cents and the delta is only 20. And that's really the key to understanding this stuff and using it. So what makes stock trading different than trading what makes vol trading different than trading a stock? Over the long term, we know where implied volatility of a stock or index is going to go. We do not know where the stock price is going to go. And let me just pull up, here's a picture of Apple. Moving around, right? No discernible pattern. Now take a look at VXAPL. Now what is VXAPL? VXAPL is the VIX of Apple. And that has an extremely discernible pattern. All right? I would say that over the long haul, Apple vol's right around, here. Something like that. Call it 28%. And that is because a stock price can go anywhere and stay there. And while volatility can go anywhere, it can't stay there. It will revert back to its mean. And this is the key. All right. Now, it must revert back to its mean over time. Understand this can help with buying and selling. All right. And people that think it's a great idea to sell premium into earnings, every study out there says that premium selling in the form of strangles loses, and premium buying in the form of strangle loses as well by what amounts to the bid-ask spread. So if you don't do something smart and you don't do something nuanced, and or if you aren't good at picking direction, don't trade earnings. Earnings are a crapshoot. I almost never trade them unless I'm very certain on what I'm doing. So in general, when implied volatility is low in the near term and especially in the long term, and one wants to play direction, it can make sense to buy premium over selling premium. All right, absolutely. All right, and the quick way to look at things is that we kind of put volatility into 4 segments: low volatility, somewhat low volatility, normal, or what we call mean volatility, and high volatility. All right, and that's the way we look at things. So when volatility is low and at the lower end of somewhat low, we're normally looking to buy, and that's for a stock and for indexes. And when volatility is high or normal, we're looking to sell. So let's talk about why. Well, if you want to get long, there are 2 ways to do it. You can sell puts or you can buy calls. And each trade acts very differently. A short put is long delta and short volatility exposure, or vega. Thus, the trader is actually hoping that the stock moves higher and that implied volatility falls. So what makes implied volatility drop? What lowers the price of an option? Well, what lowers someone said the stock goes up. That's not necessarily so. All right, I've seen a lot of situations where underlyings rally and vol goes up. All right, what really drives lower IV is reduced uncertainty. That's good. Reduced movement, right? So IV is really kind of related to movement. So it's really reduced uncertainty, reduced movement, or reduced expectation of movement. All right, so either you're less afraid, you expect less movement, and or the underlying actually just isn't moving. Those are the things that are going to drop implied volatility. So when you're trading a short put, you're really trading on falling movement. So when you sell a put, you are betting that the underlying isn't going to go down. You're not betting that it's going to go higher. Very different approaches and concepts. So here's JP Morgan, all right, from a while back. JP Morgan's trading, kind of going through a rough stretch in January. This is January last year. And so you look right around 55. This seems to be kind of the level. All right, and you've got volatility well above, into 23, 24. This is an excellent opportunity to sell puts. When you see volatility bid, and someone's going to say, well, I see a clear double bottom pattern or a 4th doji or something like that. Well, congrats. I see an opportunity to sell a put that's expensive. All right. So now a long call is long delta. Isn't it risky selling a naked put, though? Good question. If you don't want to sell naked puts, then sell put spreads. All right. Well, you know, some people want that kind of directional risk. You know, I'm not really talking about delta neutral trading here today, Phil. Although I definitely have a strong understanding of that. All right. So when a long call is long delta and long vega, you've got volatility exposure. All right. So what the trader is really hoping is the underlying goes up and vol goes up. Are there specific vol levels that determine whether you buy or sell premium? Depends on the stock. Every stock has its own volatility levels. So for instance, in IBM, there are certain levels where I'm always going to want to buy premium. And in IBM, there are certain levels, earnings aside, where I'm going to want to sell premium almost every time. And same thing in Goldman, JP Morgan. So it's getting to know the stocks, getting to know their volatility. S&P, same thing. All right. So the question was, are there specific volatility levels that determine whether you buy or sell premium? And my answer was every stock. The answer is yes, but it's stock dependent. So the trader is hoping that underlying goes up and movement goes up. So what makes that happen? An increase in movement, an increase in expected movement, an increase in uncertainty. All right. So you're betting the stock is actually going to go up, and you know, there's a lot of good instances of that happening. So this is Ulta. I love to trade Ulta Cosmetic. I don't know why. It's one where the patterns are really easy to kind of spot. It does. And the question is, don't IVs drop when prices go up? Only when implied volatility is too high. There are a lot of times when IV can actually be low. Are there any differences in behavior between IV of premium single stocks and ETFs? ETF vol is typically more expensive than single stock volatility in relative terms. Hilarious. So, Phil, there is a huge difference between index and ETF vol, which tends to be too high, and stock vol, which tends to actually be a little too low sometimes. When you're long call, are the times IV goes up? There are times when IV goes down. I traded Apple long call, some IV goes up, my premium goes up, but then it can also drop. That's absolutely right. It can go up or down. So look at this case. This is a case of Ulta, and this is where implied volatility got really oversold. And, you know, we went to go long about the 170 call in and around here. And this red line is implied volatility. What happened? Straight to the moon, and the stock does the same thing. I love when a good plan comes together. And those are the types of things. If you get really good at spotting low volatility, you'll experience this a lot, and it works, and it makes directional trading much, much easier. So like getting short, like getting long, when one is making buy-sell decisions, you take IV into account. When implied vol is high, sell call spreads or calls, typically call spreads. And when IV is low, buy puts. So here's IBM. This is one where the IV got super high for multiple periods of time. And, you know, you had a sell here and a sale here. And it was like the one, we did, I think, the 165.70 call spread on multiple occasions. Kind of every time it got a nice little pop, we would sell this call spread. It was just beautiful. And now here's IBM when they let volatility get too low. And for instance, IBM, anytime IBM premium gets below kind of the 16, 17% implied volatility, I become a buyer. And this is recent, from August. And you can see, look at what they did here. They creamed volatility even as the stock is dropping. And I'm going to tell you why, how and why that happens, and why it's such a good signal momentarily. RSI returns the mean. Is there any relationship to IV? I forget what RSI stands for. You're using IV 30. Are there times you would use longer dated? Yes, especially if I'm looking at a longer dated trade. How do you find volatility of every stock? I use live vol. Should we actually trade based on IV or HV? Trade based on IV. Use HV as a guide, though. All right. How does volatility drop when the stock price drops? I'm going to explain. Relative strength indicator. Yeah, I know a lot of people that use those. I do not. I do not. So my answer is I don't know. All right. Are you concerned about a stock direction with high or low vol? Yeah, that's why you've got to take that into account. I definitely look at support and resistance levels, things like that. What was the trade where you have vol circled? Buying puts. Absolutely buying puts. I believe we bought like the 55 put, the 155 put, and let this sucker die. They should stop calling it IBM and start calling it DIBM. Talk about terrible management. The CFO hasn't been fired. He should be. All right, so now let's talk strike selection. Strike selection is really, now that you understand volatility, yeah. Now that you understand volatility, let's talk about using volatility in strike selection. So the next step is to select the right strike. So this is done based on the certainty of the next vol move. So when one believes that implied volatility is going to go up, use what's called a softer delta. A softer delta. Softer deltas, I'm going to talk about what those are. And when one believes that IV is going to be firm or stable, use what's called a hard delta. A hard delta. All right? Will TOS give you volatility charts? Not accurate ones. That's why I'm a big proponent of live vol. Really good, accurate vol charts. I mean, Thinkorswim can't even figure out how to properly do the volatility. Can't actually figure out how to properly do the Greeks and volatility for VIX options. Think about that. So, yeah, IBM buying hundreds and hundreds of millions in stock buybacks when they're $200 and almost none when it's trading 140. Nice work, guys. Yeah, so traders saying you're correct that TOS vol figures are bad. They're really bad. They're almost unusable. I don't like them at all. So, they're what we call Thinkorswim is kind of like it's a little bit. It's like it's a trader bimbo. It looks good it looks good until you start actually trying to use it. Vols on trade stations are supposed to be pretty good. What do I use for vol? I use live vol. I use live vol X and live vol core. And if you got questions on those two, feel free to email me, marketoptionpit.com. Yeah, well. How is SIBO with volatility? SIBO actually bought live vol. So think about that. So now let's talk about what is a hard delta. A hard delta is relatively resistant to changes in volatility. I will at the end. All right. Hard deltas are in the money and at the money options. All right. A soft delta is relatively dependent on changes in volatility. And it's going to be out of the money and far out of the money options. Understanding the difference can help with buy and sell decisions. All right. So when would I want a hard delta? I use a hard delta when I'm not sure of the IV movement, when IV is very high, and when one isn't sure the severity of the expected move. And this is on buying. So I'm going to talk about buying decisions, then I'll talk about selling decisions. So let's take an example. Here's Goldman Sachs. This is an old example, but it's really good, so I don't change it. All right. So Goldman Vol is in the 30s, and it's trading around 115.5. And I think it's going to go higher. Well, look, it does. So I've got two options for a trade. I can buy the December 110 calls, or I can buy a bunch of the December 125 calls. All right. Well, you can see a week later, both options are up. So what happened here? Let's walk through. If I buy one Goldman Sachs DC 110 call, I pay $7.60. I'm acquiring 70 deltas. All right. I'm spending 760 bucks. If I buy 8 Goldman Sachs December 125 calls for 96 cents, I buy 130 deltas. So I only spend an extra $8 and I get twice the exposure. Well, lo and behold, a week later, the stock's up $5. So my Goldman Sachs DC 110 call is worth $10.65. Price of profit of $305. Almost 50%. That's pretty good. Well, then my 8 Goldman Sachs 125 calls, I only made $184 on 8 calls, even though I had more long exposure. Buying the hard delta, buying the in the money option was the better play. So take a look at what happens. You've got an IV of 30, 29.60, and an IV of 26.5. A week later, IV of 27.60, and look, these are off by $4. 4 IV points. So in this case, you want to buy the in the money or at the money option. The question is if you're selling a put with the same rules, you'd flip it, obviously. And I'll talk about that. So now let's talk about the other way. So softer deltas are more sensitive to changes in implied volatility. And there's some very specific times where they can make a lot of sense to be purchased. When? Well, when implied volatility is super low. When you're expecting a major move. When you want to make a cheap bet and vol is low. When you want to make what is a real cheap bet, not a seemingly cheap bet. So here's another look at IBM. Lo and behold, look at IBM back in the day. It's 190 bucks. Look at that low implied volatility here. See that? Nice and low. So on 11/21, I can buy one of the 185 calls for 680, or I can buy a few of the 195 calls for 122. All right. Then look at the couple days later, both trades are up. Well, let's talk about how each one of them did. All right. All right. So my 185 call was 75 deltas for 680 bucks. I actually spend $70 less on my 195 calls. I buy 5 of them for $1.22, and I get double the vol exposure. Spent 610 bucks. Well, a couple days later, the stock's up $3. I made 250 bucks on my 680 call. Go me. That's good. That's good. It's good. Good. But look at how well my 5 calls did. My 195 calls did. I made more than double what I made on my 185 calls. Huge profit. Huge profit. And why? Well, take a look at the volatility again. See? And it's up. That makes a difference. So the same logic for hard and soft deltas applies to premium sales. It's just flipped. All right, so when one thinks that IV is going to drop, sell softer deltas, sell out of the money put spreads and out of the money call spreads. When one thinks that IVs could stay firmer, sell more in the money and at the money type stuff, or buy debit spreads, if you will. All right, so now I'm going to tell you about a couple of trades that I use. All right, and this is my absolute favorite directional trading. So follow vols. So you can follow VIX methodology that SIBO disseminates. You can follow the vol index, the vol stuff that live vol uses. All right, so when a stock hits a 52-week high, all right, so when a stock hits a 52-week high, all right, I wait a day. So when a stock hits a 52-week high and volatility is at a 52-week low simultaneously, all right, I wait a day for the stock to back off a little bit because usually it does before they go off more. And then I buy the first call that's out of the money. That's at about 30 days to expiration. You can go as far out as 60 days if you want. So this is a trade that I use all the time. This is Goldman Sachs. Below is VXGS. These are the only vols I trust out of Thinkorswim are the ones that the CBOE disseminates, which is VXGS, VXAZN, VXIBM, VXGOG, VXABL, APL. CBOE has about 50 vol indexes that they disseminate. Those are good. If you're going to use TOS, stick to those. So you can see Goldman Sachs vol. When Goldman Sachs vol gets below 18, it is a buy, no matter what. I mean, it's like clockwork. So take a look here. Goldman Sachs right here is at a 52-week high. And the volatility right at a 52-week low. So you buy a call. All right. And let her ride. Woo! Cha-ching. All right. That's a trade I've done over and over and over again. All right. Here's another one. Here's Tesla. Take a look here. All right. You've got really low volatility in Tesla. Kind of in here and in here. And you've got the stock at this point trading right at the 52-week high. All right, so you get the earnings drop, and you wait a few days. You can buy kind of right in here. Here was one opportunity, vol at a 52-week low, just popped out of earnings. That's another one. When a stock really blasts off on earnings and implied volatility gets creamed, I'm a big buyer. How would I know when to sell the Goldman Sachs trade? That's a good question. What I generally do is I have every time the stock makes so much, I just dump pieces of it on the way up. All right, I'm actually looking at how much I've made on my options. I don't even pay attention to the stock price. That way I don't get greedy. Now here's an interesting one. Here's one where this sucker is getting kind of pounded around and they're killing volatility. What do you think I was thinking about doing here that ended up working out okay? It rhymes with schmong, schmut. Long put. That was looking like an opportunity for a long put. So now here's another trade. So when an IV or VIX methodology hits a 52-week low and the stock is at a 52-week low, buy a put that is the second put out of the money about 30 to 60 days out. Sinking IVs and sinking stocks almost always mean the stock is going to go a lot lower. Why? Why do you think falling IV and falling stock? So if this can throw people off. So the reason why I like buying calls when a stock is at a 50-week high and the vol is at a 50-week low is that typically means there's too many overwriters, too many people selling calls. So in the case of Tesla, you probably had a lot of people selling the 250 call here, all right, to produce income, and the vol is really cheap. So what happens? Well, you go along that 250 call that everybody's dumping, and then as the stock moves higher, what happens? Everybody's racing to do what? Cover their short. Yeah. So with the put, the question is why do they dump? Why does low IV in a low sinking stock? Yeah, the answer was no interest in the stock. That's a good answer, and that's close. And it's true. People are selling their stock instead of hedging it. Do I need IV the stock or the VIX? Both. All right. So when nobody's buying puts and a stock is dropping, all that means is everybody's just selling their stock, and nobody cares. So the stock's going to keep going. So this is GLD and GVZ. GVZ is the VIX of gold. And you can see they just torched gold volatility and then subsequently torched gold. And here you got really low vol in gold and just incredibly cheap option premiums. This was one of the best put purchases that I've ever seen. We did this in the strategy letter. It went well. So now I'm going to briefly tell you about an intraday VIX thing that I look at. So I follow the VIX futures and the VIX and VXX pretty extensively. My hedge fund trades a lot of VIX and SPX. All right. So one of the things I look at is ES and SPY. So in these cases, historically low vol is like a trend continuation indicator, right? That's correct, Phil. So one of the things that's interesting is that S&P futures and SPY are almost always led by VIX futures and VXX. There can typically be a tell of what's about to happen as in a day trade. Let's take a look. This is from a while ago, but I could pull up one from today actually and show it to you. So you've got SPY just kind of sitting there in a range. And then this is VXX on the lower end. And what's going on? So SPY's range bound and VXX is doing what? Rallying. That is a great intraday indicator that something bad is going to happen. That the underlying is probably going to fall. So if I were actually to pull this up today, this is live vol X for people that were asking what is live vol X. So I'm just going to pull up one for today. I probably should have prepared this, but I just thought this will be fun to look at just now. I mean, super range bound today. All right, so then we'll do VXX. And I'll pull up a new tick chart. And this is off the top of my head, so if it doesn't work, I'm going to feel a little stupid. So take a look at the two of these. And look at this morning. Even as S&P is kind of sitting range bound, you have VXX rallying all day. And you can see it kind of led to, it's not perfect, but you can kind of see how VXX is kind of calling for, starts rallying before really the SPY started falling apart. It kind of led it all day. And it typically does. So I want you to notice, and it doesn't always, but generally speaking, VIX futures and VXX will start moving before SPY and ES. So when I see this on an intraday basis, it's almost always a sign that the market's about to sell off. Same thing on a low market and volatility is falling. That's usually a sign that we're going to rally. And it can point toward an intraday high as well. And it's one of the strongest indicators of the market turnaround. So in summary, volatility reverts, implied volatility helps form positions. There are different types of delta, and understand the sensitivity to change in IV, and understand that VIX and VIX futures lead. Now, here's why you're all here. All right, well, here's what I'm offering. On December 5th, all right, so this is going to be on December 5th, starting at 9:30 Eastern time. Andrew and I are going to teach a 4+ hour directional trading class live to you guys. All right, I'm going to want to confuse anybody. We'll do December 5th. All right, and we charge retail on these $247. You sign up by next Friday. That's next Friday after Thanksgiving, and it'll be $147. And use coupon code 25_off, and it is case sensitive. So 25_off, and you can take $25 more off. So $122 for this course. So that's 4 hours for $122. That's about as cheap as you can get it. And we will record it. You get to keep it and watch it. 4+ hours. You're going to learn a lot of stuff. Is there a charge for Option Pit subscribers? No. If you have an Option Pit Live subscription, you are a Gold subscriber, you are a Platinum subscriber, these Saturday classes are always free for our members. All right, and if you consider a monthly membership is $125, it's a pretty good deal. I mean, basically, they pay for our the Saturday classes. Now, the Saturday classes are great. It's 4 hours long. Go to optionpit.com/dir primer. You will get the slides. You'll get the recording. You'll get email support. So 4 hours is too long to concentrate. Well, then leave and watch part of it as a recording. We do have a couple of breaks in there, so don't worry. I let everyone go to the bathroom and go grab a cup of coffee. So optionpit.com/dir primer. It's going to start at 9:30 Eastern time and run till 1:30 Eastern time on December 5th. And again, everyone will get a recording of it. Any other questions? And we're going to learn, and you're going to, if this was useful to you, no, your access to the recording will not expire. How often are Saturday classes? Just about every month. Just about every month. I would say probably about every 5.5, 6 weeks. So, I'm looking at LiveVol's website. Do you think LiveVol Core with TOS can be effective? I would just open an account with Tradier. Tradier is a brokerage firm, and you just deposit $1,000, and they give you LiveVol Core for free. LiveVol X, which has more risk analytics and some really cool stuff, is also free if you open an account with Lightspeed. So both of them are really brokerage platforms so that you can get it for free. All right. So otherwise, LiveVol Core is $100 a month. LiveVol Pro is $300. So I get, because I trade through LiveVol, I get this awesome LiveVol X that I use for all of my scanning and all sorts of cool stuff that I do. So I look, one of my scans, I look for symbols that have a new 52-week low implied volatility. I also look at ones that have 52-week high implieds to do some other things. Great. Do you have a trading service where you give out trade ideas? Yes, that is our Option Pit Live service, and that is $125 a month. Did I send a recording? No, we're going to do an encore one, which will be, I'm going to actually, this is almost the exact same one that I did yesterday. I am